Greetings from 3Edge Asset Management. My name is Fritz Folts, and I am the Chief Investment Strategist here at 3Edge. Pleased to be joined here today by Steve Cucchiaro, President and Chief Investment Officer at 3Edge Asset Management. Today is Saturday, April 4th, and this short video is part of an ongoing series that Steve and I will record at the end of each week. It feels a bit strange to be talking about the financial markets during this global crisis, which is obviously human tragedy of enormous proportion, but we also realize that it is our responsibility at 3Edge to protect our clients' assets during the crisis, and we take this responsibility very seriously. So let's look back at the week that was. Earlier this week marked the end of the first quarter of 2020, and for the quarter, the S&P 500 was down over 20%. However, at one point last month in March, the S&P was down almost 34%, but a four-day rally helped the index to recover somewhat from its worst losses during the quarter. So Steve, kind of amazing, but during this quarter just ended, markets experienced a sudden and steep decline, and then one of the most dramatic rebounds in market history. And so investors are asking, have we already experienced the bottom of the market? Now, before you answer that question, I would like to refer to one of my favorite quotes about bear markets. And the quote is, during a bear market, when it is time to buy, you will not want to. So the question to you is, what does a market bottom look like and feel like, and have we already experienced one here?
Well, time will tell, and that will depend on decisions and actions and events that haven't happened yet. But I will tell you, it's useful to look back at history as a guide. So let me just go back to the most recent bear market we had before this one, which was during the financial crisis of 2008. The market went down lots more than people expected, and every time they thought it might be a bottom, there would be a rebound until early 2009. But just for everybody's perspective, the market bottomed on March 9, 2009 and began a rally and never looked back. The economy kept going down, and the economy didn't bottom till 9 months later. So the reason why the bottoms are so tricky is that the stock market will try to anticipate the bottom of the economy several months in advance. And I can remember March very, very well. Nobody wanted to buy at that time. Everybody said, sell. I'm done with equities. Get me out. I don't care what the price is. I can't take any more pain. And then while the economy kept going down, the headlines kept getting worse, the market did bottom. One other perspective, if we go back in time, let's look at the crash of 1929 and the Great Depression. There, we had 6 false bottoms before the final bottom. 6 times the market was convinced it can't get any worse. 6 times we had a pretty substantial rally that drew money back into the market, convinced that we had the bottom. 6 times the market then fell below the previous bottom. It wasn't until the middle of 1932, which was 2 years and 9 months after the peak, that we had the real bottom. And that even wasn't the bottom of the economy. The economy was still going down, but it was the bottom of the stock market. So it makes it very tricky to know if you're at a bottom or if you're at the bottom.
Right. Very good. Let's take a look. I mean, obviously, all of the news is focused on the COVID-19, the global pandemic. And it's difficult in many ways to imagine what the world will be like once we come out of the crisis. So one question that investors have is, well, what will the economy look like when we finally emerge from this crisis? Will everything go back to normal? Will we have that V-shaped recovery, or will it take much longer? How might we think about that?
So certainly we'd all love a V-shaped economy. And many people hope and expect that. The most optimistic view I heard was from our former Fed chairman, Ben Bernanke. He said, don't think of this as a normal financial crisis. Think of this as a major snowstorm that came in, hit us badly, and then is going to leave. And so he was proposing that we're going to have a V-shaped recovery. We don't think that's very likely for a few reasons. One is that this is not only a major health shock, but it's a major shock to the psyche of consumers everywhere. Many who have lost their jobs or about to lose their jobs. Many who find that they didn't save enough for a rainy day. And so it's likely that consumers will have a hard time getting right back to normal, but will be cautious. Next, there's always a threat of a second wave of the coronavirus. Even if this peaks and goes away in a couple of months, people might be cautious how in history, sometimes you get a second wave. So there's that threat. Third, there's no doubt that businesses are going to change practices about their global supply chains and about how dependent they are on other countries. And so we could continue to see a decline in global trade that started with the trade war that began over a year ago with tariffs and so on. But this could actually make it even worse. And then finally, one of the biggest worries that we have is that before the coronavirus hit, the corporate bond market was like a ticking time bomb. Mm-hmm. Companies were encouraged to borrow lots more money than they normally would with the low interest rates that the Fed was promoting, and with investors willing to invest in riskier companies for just a little bit more yield. And that made companies borrow record amounts relative to the size of their company or the size of their cash flow. And so it was a ticking time bomb, meaning that as long as we never had another recession, that could be sustained, almost like a Ponzi scheme. But now that we're in a deep recession, those corporations are having a tough time. Rather than saving for a rainy day, they use their cash to either pay dividends or in many cases to buy back their own stock at prices higher than we are now. And so now they're really scrapping for trouble. Certainly the government and the Fed are trying to intervene and help them very, very much, but there's only a limit as to what they can do. Now, one other experience I can talk about is back in 1918, we had the so-called Spanish flu, which was the last major global pandemic. And as I read about it, it lasted about 2 or 3 months. It went away and everyone celebrated in the streets. And then a second wave came back. So the whole episode lasted about 9 months.
Very good. So I have one last question for you, and that is, I know that you're a board member at the Institute for Health Metrics and Evaluation, and you have shared some of their updates on COVID-19. Do you have any most recent updated information from IMHE in terms of their models, and what those may be indicating for the path forward for COVID-19 from here?
Well, thank you for asking, Fritz. You're right. I am on the board of directors of the IHME. We're primarily funded by the Bill and Melinda Gates Foundation. We're affiliated with the University of Washington. We have over 500 data scientists working full time, building, maintaining, and refining the world's largest database in modeling and forecasting framework of health and disease data. Our clients are the World Health Organization, the United Nations, nearly every country in the world. And I've been in contact with Chris Murray, who's the head of IHME. And he's been sharing me his forecasts and updates. He's now posted them on the internet, so it's within access to anybody. I know we shared links with all of our clients. Mm-hmm. He does have an update coming later today. I was hoping it would be right before this video conference, but the latest update is very much on target. His forecasts so far have been right on the money. And the current forecast for the number of deaths that the US will suffer as a result of this first wave of coronavirus is 93,000, which is a very sad, tragic number. Yeah. Now, there is a range. There's a best case scenario of 40,000, which, while a lot better, is still very tragic. And there's a downside scenario of 175,000. And it could be even worse if we don't get all of the citizens of the US practicing the social distancing. Now, one thing I will say is, in terms of how to think of it, not just from a human tragedy point of view, but how it might affect the markets. We have looked at past situations where there have been global health crises like AIDS and SARS and MERS, and there have been pandemics. And there usually is a market bottom, even if it's not the final bottom. There's usually some kind of market bottom when the peak in deaths per day happen. And it's kind of a sad thought. Right now, the forecast for the US is that we will have a peak sometime in the April 16th to April 21st timeframe, plus or minus. Mm-hmm. And then it will slowly get less worse.
Yeah. Whew. Well, yeah, sobering, as you said. But I mean, it's really their data is showing up everywhere, including in the White House briefings these days. So very interesting, their model. So
Well, it's
Steve,
interesting. In my conversations with Chris, I've been asking him about his latest forecast, and he's been asking me about our latest forecast. So it's pretty funny.
very good.
Yeah.
Excellent. So listen, thank you, Steve. Great to get your insights and your perspective. As we all try to make sense of these tumultuous times, I want to thank everyone for listening. This video will be available on our YouTube channel, as all of our videos are on our YouTube channel. If you go to YouTube, simply search for 3Edge Asset Management. You will see our full archives of video there. If you would be so kind as to subscribe, you will also receive all of our latest videos on the global capital markets as they come out. So in the meantime, as always, please feel free to reach out to us with any questions. From everyone here at 3Edge, stay safe, stay strong, and keep the faith. Thanks for listening. And Steve, thanks again.
Thank you, Fritz, and thanks to all of our clients.